Welcome back to Rockstock Channel. It is Tuesday, August 23rd. Very privileged to have here John Miller of Cowen and Company. John, why don't you just start out and describe what you do for Cowen, and then I'll come in and then kind of frame where we want to go with this conversation.
Howard, thanks for having me. I work for Cowen. Cowen's an integrated investment bank and broker dealer. I sit on the research side, specifically within a group here in Washington, D.C. that covers policy, everything regulatory, everything legislative that would affect the investment community. So my colleagues cover things from healthcare to general macro and defense. I'm in a new seat covering a vertical around ESG and sustainability. Our view at Cowen is that as the ESG narrative begins to really focus on specific targets on a go-forward basis, including in the E column, so things like decarbonization or penetration for electric vehicles or renewable power, to complete that investment thesis, the underlying regulatory and legislative base needs to change. And so for that to change, there has to be a change here in DC. So we're covering all things related to that, and critical minerals, lithium certainly falls into that.
The Inflation Reduction Act was passed, and that follows the CHIPS Act, which is not really that relevant on this part of the supply chain from an EV perspective. But prior to that was the bipartisan infrastructure law. And in between that, there were the Defense Production Act was given, two separate dollops of 500 million each as it pertains to critical materials. I think one was tied to a Ukraine bill and the other was, tied to the bipartisan infrastructure bill. There's been a lot of press, the stocks went up, after this. I said, Manchin and Schumer snapped victory from the jaws of defeat. When we met in Phoenix, you actually keynoted the Fast Markets event. I think you were the first presenter on the first day, but you gave a relatively bearish outlook. What happened? The Build Back Better Biden bill, which was meant to be kind of like 3 trillion, here we have something that's 380 billion. The fact that it kind of made the cut, like the size of the package, Build Back Better Biden, was reduced by 90%, but it really speaks to how much they prioritize EVs, and climate or things that are consumptive of critical minerals. Why is that?
I think the point I was delivering during that conversation is there's an ongoing disconnect between what this administration under President Biden wants to accomplish with, broadly speaking, the energy transition. So that's electric power and decarbonizing transportation, and what they're willing to really fight for on the ground when it comes to individual permits for projects moving forward. At the macro level, this administration is 100% bought into the Paris Agreement, which we've rejoined, a 50% emissions reduction target by 2030, 50% light duty vehicle penetration for EVs by 2030. Macro level, they're all in. When it comes to where this actually hits the ground and where shovels need to begin digging to extract the critical materials, there's still a disconnect and there's still a risk. And that's mainly around the permitting process itself, which has become bogged down in a number of different directions, right? Some of that is an external lobby that's been litigating, and some of that has been an internal problem with some of the ways the agencies operate. And so I'm certain we'll get to this, but there is an opportunity in the next month in September for some real reform to the permitting process that simply wasn't on the table when we spoke a few weeks ago. I see it as two almost parallel asks. One is decarbonize the economy, accelerate the energy transition, and then do it by bringing all those resources, all that activity, all that manufacturing back to the US. And that's difficult to do, right? Right now, the entire value chain for renewable power, transportation has been moved towards lowest cost, towards economies that don't price emissions, and it's an externality, and that's all gone to China. So if we want to continue the acceleration and actually get panels and cars, we have to go to the lowest cost. If we want to have the domestic side, we're gonna have to make some changes to those value changes, and the bills and the actions you've mentioned today are supportive of that. So 2021 was the Infrastructure Investment and Jobs Act, IIJA, or the Bipartisan Infrastructure Law. So it's sort of the first real cut at what this administration can do from a spending perspective to be supportive of that demand for these critical materials. And so in that space, there's more than 6 billion that will be coming over the next 5 years for battery processing, manufacturing, and recycling grants. To date, 1.8, just under 2 billion has been made available through what's called a funding opportunity announcement. So the Department of Energy is managing that. They put out this request. Companies can compete for that fund. Those funds are grants. So that's, a little bit less than a third, and the rest of that money will be coming over 5 years. Going forward into 2022, the Russian invasion of Ukraine really accelerated what the executive office would do in the US around the energy transition, and obviously materials are a big part of that. So we did see a DPA announcement, a DPA's Defense Production Act. And so you mentioned 2 additional $500 million slugs, super helpful. The announcement around critical minerals it went about as far upstream as at that time the administration was really willing to do. So it was around processing, it was around efficiency gains, it was around engineering, sort of the industrial and engineering opportunities around a mindset, not actually making direct equity investments into mines. That might change going forward. And then now, really, since the end of July, there was an agreement between Senator Manchin and Senator Schumer, which pushed forward what used to be called the Build Back Better Act, and now it's the Inflation Reduction Act, or Mr. Manchin's bill, whatever you kind of want to call it. I like your point. So the initial BBB was north of 3 trillion. The Inflation Reduction Act, about 370 billion for climate and energy, and vehicles, minerals, those are all part of it. So happy to unpack like the manufacturing elements or the clean vehicle credits, the commercial vehicle credit.
But before we go into that, let me just kind of summarize the other 2 things you mentioned, which are the Defense Production Act, 500 million, so that's $1 billion, and then these 6 billion of grants, of which 1.8 billion or so has already been applied for. The bipartisan infrastructure law is only for U.S. projects. The Defense Production Act, as I understand it, can also be applied to Canadian and Australian and maybe a couple of other countries who are deemed by the Defense Department. The DPA is a Defense Department thing. That the bipartisan infrastructure law, I think that comes from the Department of Energy. But the DPA, Canada is considered a domestic source. I speculate that there is some money, and those are grants, like free money potentially going to go to certain Canadian, US, maybe Australian projects, to the extent that we see an announcement by the US government and any one of those companies of receiving such free money. It will catalyze, and people will realize that not only those companies, but funding is being made available from the United States. And we may hear this year or in the next month or 2 some awards from those programs. Then the bazooka, right? Congress has, there was a New York Times article that talks that the Loan Projects Office is getting like a $350 billion number. I saw Jigar Shah on LinkedIn say that he's gotten an additional 40 or 50 billion on top of what he already had was 40 billion, because he's been out there, and there's a number of companies like Lithium Americas and Piedmont and Ioneer who have publicly announced that they're applying for these are loans, though. These are low interest, long-term loans. There's more money available, right? And also, if you could talk about embedded within that, our expansion of these investment tax credits, through the 48C program, which has not gotten a lot of press, is not well understood, but is not a loan. It's essentially, free money.
DOE's loan program office has received significant extension on its funding capabilities through the Inflation Reduction Act. 350 billion in additional credit ability from LPO is huge, right? And it's also coming at a really unique time where LPO is finally staffed and ready to operate as a bank again, right? This is a program that goes way back to the Obama administration, got some money out in the early time periods, and then ran into really strong political headwinds around Solyndra and kind of went into hibernation. The Trump administration didn't use it at all. It was basically shuttered. Biden spun it up again, brought in Jigar Shah to run this organization. And it's taken him, a year and a half to staff and build the due diligence and project framework. They released their first conditional loan guarantee, the first loan guarantee in 10 years earlier this year. So at the same time, the LPO is ready to do business again. They're getting this huge increase of funding. They've also spoken really eloquently about moving from funding programs that aren't commercial yet to focusing more on like deployment of large scale. So something as straightforward as acquiring the minerals, the processing, or getting towards the battery manufacturing is going to be really in their alley going forward. And so there's a large amount of money to get that done. They had about an $80 billion pipeline of applications coming in, about $40 billion of authority. Now with that additional 350 billion on top of that, that it's going to move a lot faster, and we'll see those announcements at a high rate. So that's on the loan or loan guarantee side. But to your point, yes, there will be it is a loan, so you have to pay it back. The Inflation Reduction Act also really has all these manufacturing elements too. So there's two credits that are in play, and you mentioned 48C. So this functions like an investment tax credit. It's called the Advanced Energy Product Credit. And basically for projects that qualify, if you're a qualified facility, you can get 30% investment tax credit of the investment you make to build a new facility, right? And so that could be, kind of that processing and up space for the critical materials, which is a big deal, right? That's 30% off the top if you're a qualifying facility. It is $10 billion capped for total allocation. The other credit that's in this space too as well is called 45X, and that's an advanced manufacturing production credit. And that can allow you to achieve 10% of the cost for production of the actual mineral. So that goes up even further upstream to the actual production of the mineral itself. There's no cap on that program. So it's estimated that the total investment is going to be around $30 billion. Most of that's going to go for solar, but there's certainly a place to play for critical minerals and processing on top.
Could you get both the 48C and the 45X?
No, you need to choose between an upfront 30% or the ongoing credit.
There's still things to come on the implementation side. There's a very significant carrot, and what I'm focused here is like there, I don't think there's that many sticks, right? But there's various carrots, and some of the carrots are consumer driven, right? EV subsidies, and then there are others that are producer driven. And I've been much more interested and focused on the supply side, incentives. So we haven't had supply side incentives. We've had EV subsidies, but here, if you have $1 billion project, right, or 500 million to build a lithium plant, or $1 billion to build a lithium plant, if you get a 30% tax credits, basically, then it's a it's a 350 or a $700 million plant. I mean, that's a very significant free money situation. We may hear on the grant side, but we may also hear on some of the companies that qualify for this coming up soon.
And that's very much on purpose, right? The big part of this bill, again, there's those two parallel themes here. It's advancing the energy transition and doing it at home, right? So all the changes that we're seeing in the Inflation Reduction Act, these are the things that Senator Manchin has spoken about. This is really his bill and his concept, right? He's been arguing that, one, he doesn't think electric vehicles are necessarily right for his state in all environments, and two, he's concerned about a transition to electric vehicles because all that would mean is the U.S. would now be geopolitically exposed to China as opposed to exporters of fossil fuels. So he wants this industry, okay, if you're going to do that, let's make it happen, right? If the industry's been saying we can do it's U.S. jobs, we can make this happen here. There's all these parameters to bring this home, and you're absolutely right. It's all carrots, it's not sticks. That's also deliberate too as well. That's how Manchin legislates. He does not like fees. Like, he was very much against a fee for utilities to show an emissions reductions on an annual basis, basically trying to hit a backdoor way for a carbon price. He was very, very much against fees and negative structures. He likes carrots, right? Let's incentivize through tax policy for companies to go ahead and do something we want, as opposed to penalize them for not doing it. So we're seeing that all over the space. So it's across the value chain. It's not simply upstream, it's processing, it's manufacturing the battery, and then it's final assembly of the vehicle too as well.
And I've watched Manchin for a while, like our friends at Benchmark Minerals, when Simon Moores has been presenting in front of, like, it was Murkowski at the time when the Republicans were in power. He was always like the number two, the ranking member. Now he's the guy. So, and that is like one of the most bipartisan committees that there is, right? Like this is one, area where it's not being reliant on China for critical minerals has wide bipartisan support, compared to last year when they were talking about like on the EV subsidy side an extra credit, right? If you were union made, right? And the income thresholds for who would qualify, it was like up to 400,000 or 500,000 in income, and the vehicles, price tag was very high. As I've looked at what's actually made it into law, it sounds like Manchin's like, okay, we don't want to subsidize rich people, we don't want to subsidize luxury cars, and we don't want to subsidize buying imported materials from countries of foreign concern,
Foreign entities of concern.
foreign
Yes.
entities of concern. So there have been, like, I've been watching Twitter, and a bunch of the Tesla people were like, oh, they say they've expanded the credit, but they haven't expanded the credit. But the reality is Tesla has met their 200,000 car threshold. Now they could sell unlimited amount of cars over 10 years, as long as they have cars that are cheap enough, and are sourcing materials. So if they don't qualify in 23, 24, they're incentivized to qualify in 25, 6, 7, 8.
That 200,000 unit cap was extremely prohibitive. So the large OEMs that are actually producing EVs at scale and are the sink for the demand for the resources that we're talking about here, they were totally out. So this changes that, and all they need to do is not all they need to do is they need to restructure their value chain and supply chain. And if they want to achieve that credit, they can price vehicles into this market. So now we're still capped at $7,500 at the max, which is where we are now for the credit. It's two elements. There's a $3,750 critical mineral component, and same value, $3,750 for battery component requirements if the battery is final assembly is done in North America, right? And North America is a change too as well. And before had been US, so that excluded our partners in Canada and Mexico. So this is more reflective of the way the actual value chain is. The new credit, which is now called the Clean Vehicle Credit, it does for the first time include caps around the MSRP, which was not there before. This is reflective of politics. Right? The Republican caucus put together a strong narrative that the existing credit was only subsidizing affluent buyers to buy Teslas, and Democrats were out of touch, and they were pushing these vehicles that most Americans don't even buy new cars. They buy secondary sales cars, and an $80,000 car is well out of range for most Americans, and that connected with voters, and that connected with the media. So the MSRP cap is responsive to that. So we can talk through that. There's different classes. So for SUVs, it's $80,000. For vans, it's same price, $80,000, and for other, which is basically sedans, it's $55,000. And now there are significant means testing. So basically, for a married couple making more than $300,000, you will not be eligible for the credit, right? That's very different than where we were before. The existing credit is open to anyone, no matter what the earnings were, and it's even different than where the Build Back Better Act was last fall. So last fall started at $500,000 for married couples, but didn't exclude that family. It just basically began ratcheting down the value of the credit. So now it's binary instead of a reduced credit. So a lot was done around those politics, but again, it's open to GM, it's open to Tesla, it's open to Ford and VW, which will very quickly be tapped out of that $200,000 OEM cap. Achieving the credit is also much more challenging, right? I mean, we've mentioned a couple times now that there's a critical minerals requirement. So for vehicles sold under the new clean vehicle credit, 40% of the critical materials must come from the United States, recycled, or from a country we have a free trade agreement from. That's before January 1, 2024, and then it begins to ratchet up. So after December of 2026, it reaches 80%. And on the other side, there's also requirements for the percentage value of the battery component. So for vehicles sold under the new credit before January 1st, 2024, it's 50%, and that ratchets up all the way to 100% by January 1, 2029.
I think overall it's directionally right. I mean, we're in a situation in the EVs where there are long waiting lists for all sorts of vehicles. So why would you want to stimulate demand further? You have to stimulate supply, which goes to my earlier comments that there are loans and grants to help, one, increase localized supply, but hopefully that also decreases the price of the batteries so that the EVs, will be cheaper, so more people can qualify for them.
The U.S. climate policy, both on the power and the transportation side, has been just extremely volatile. Erratic is the word I wanted to use. This introduces certainty, and that certainty is a little bit, the structure and the methodology is a little bit different than it exists now. And So the market will need to adjust to that. But having a 10-year outlook, not having your largest producers of electric vehicles totally capped out of a market, that's a positive, right? And so the market will adjust to that. Long term, these are all positives. In the short term, there will need to be some adjustments that certain companies will need to make. And the value chain certainly will have to change too as well. But that was the objective, right? The objective was to move away from this lowest cost China-based model towards the United States and our friends and allies through these free trade agreement arrangements.
A company like Albemarle, is an American company, right? But they produce out of Chile, which is a free
Mhm.
trade agreement country. They also produce, partly in Australia, right? But they ship rocks from Australia to China, and they convert those rocks into like a final product that ultimately then comes into, a Tesla in the U.S. So would that qualify if the final processing is happening in China, but most of the other bits are happening from either an American company or from a free trade country? Does it qualify, right? Like what is a foreign entity of concern?
Yeah, so there's two components here. One is the percentage that needs to be hit for critical minerals, the percentage needs to be hit for the battery value. That's sort of one element. Those ratchet up over time. And then there's an entirely other piece at play here. And that's a blanket binary exclusion for foreign entities of concern. So that in the hypothetical of ore mined in Australia, that is acceptable. That's perfectly eligible in the vehicle. It would actually be beneficial and help towards that percentage that needs to be achieved. If that ore then goes to China for processing, that would be problematic, right? That would likely enter that foreign entity of concern, depending on the final processor in that country. It would make that vehicle ineligible. So there will have to be a shifting of these value chains. The processing, for sure, anything around the battery manufacturing and the components that go into the battery manufacturing, if they touch foreign entity of concern, that vehicle will not be eligible for the credit. So there will be a shift. There'll be a change in that example.
Okay, so in that example, it's possible that Albemarle could redirect some of its ore from Australia into America, and then everything would qualify.
Or another partner with an FTA. Yep.
Yeah. Okay. So what about Argentina? Is not a free trade agreement country, whereas Chile is, and both countries have lithium. And Livent, for example, imports from Argentina to the United States, right, to finish the product, right, and they also import to China. So China wouldn't work, but would Livent's Argentine material qualify, if it's further converted in the United States, or would only a portion of it, like with the value add portion, qualify? How do those calculations made?
Yeah, so the value add component on the battery side is going to be very interesting. That's a white space, right? So the way policy is effectuated in the United States is there's legal text that moves through Congress, signed by the president, and then the various agencies opine and provide all the guidance around implementation. And there's a push-pull. The Supreme Court has stepped in several times saying the agencies have gone too far in their interpretation. We just recently saw that in a case, West Virginia versus EPA, which touches this from a climate perspective. But the percentage value of that battery component, the DOE is going to provide guidance on that. Hopefully by the end of the year. Again, that seems unlikely. Probably Q1 2023 is when we see that. What's going to happen for Argentina? What we expect to see is a lot of pressure on Commerce, United States Trade Representative, to begin cranking out resource and critical materials specific free trade announcements, right? It won't be a blanket across the country. There's no time to sort of manage all those different elements of all the imports, exports that come from it, but it'll be targeted for specific items, and there'll probably be a number of these. So Argentina is a good example. Indonesia is another example where those conversations will really accelerate. What we see, or what we believe is less likely, are waivers or exclusions. This entire bill and framework is a compromise agreement between what Senator Manchin was willing to do and the Biden administration's, again, desire to decarbonize the economy and to do it in the US. If they issue a whole bunch of waivers, they're undermining that doing it in the US process, right? So it seems unlikely they go down that route. More likely that they expand the free trade agreement structure and use that as a tool, right, to attract some other sort of foreign policy wins.
Yeah, I mean, I could, like the free trade agreement, like why'd they pick that instead of like, the EU? A number of the countries don't have free trade agreements, right? So there are plenty of countries that are not of foreign concern that are also not free trade agreement countries, but there should be absolutely no reason that, and you're right, as a tool of foreign policy, why discriminate against Argentina? Like China is, you know, trying to get Argentina on their side, right? Like, and America, like, so Argentina is kind of like in play. Like certain countries are in play, and others are kind of like left, to
Yep.
to each other's camp. So you see the potential that like Argentina, it's not a waiver, but just could be free trade agreement plus,
Yeah, a
some
narrow
country.
free trade agreement focused on lithium or processed materials or
But that's good.
something
I
to
mean, but
fit
if
in.
it actually has to be a free trade agreement, that's going to take time.
Yep.
To a formal agreement would take time to implement bilateral. There may be a lot of that activity, but that's like where that falls in the priority. It'll be a lot easier if it was just like, can he executive order just adding Argentina or Indonesia?
The executive has lots of powers, and we've seen that on the solar side. The ability for the administration to step in and one thing they could do that they've done on the solar side is the administration stepped in and declared an emergency, basically said that the United States is unable to achieve domestically the number of panels it needs. We're going to declare an emergency and issue a 2-year waiver on tariffs for imports. So things like that can be done, but again, it kind of undermines what the whole purpose of this bill is. The administration wants to be firm to show manufacturers that they need to go ahead and make the investments necessary to do this domestically or with the free trade agreement countries. If they're issuing a bunch of waivers, that again kind of unwinds that incentive. And if companies think that they can sort of lobby their way out of this, then that could be a problem. Is that not going to happen? It's unclear. I think what we're hearing around DC and from the various different trades and associations close to this is there's an expectation a lot of vehicles beginning in January 1, 2023 aren't going to be eligible for this credit, and that was by design. So that's kind of our base case.
The subsidy is based on percentage, of the value of lithium in the car is going to change from year to year.
Yep.
And therefore one year it may qualify, one year it may not. Like it's very
Yep.
confusing, and who's going to be the arbiter? Is that how it works?
It's all new, right? This is all new, and that is a critical element of the implementation guidance. How are they going to determine the value versus, adding to 100 percentage points of that battery, right? And is it a look back? Is it an average? At the end of the day, the OEM is going to be the one responsible for making that showing.
Really, fundamentally, this is a climate bill, and actually a point you made, which I want to emphasize here, is that the reason that EVs have made it into this bill, right? This much more scaled down bill is because from an emissions point of view, it's transport and power that are the biggest emitters, right? So to address those big emitters, you have to tackle the transport problem. And within the transport problem, polluting trucks are much more polluting, right? That are used all the time than someone who's replacing, a Porsche 911 with a Model S, right?
Yeah.
That's the reality. So there is a tax credit or a subsidy of $40,000 for a heavy vehicle or whatever class vehicle that this so this is a significant incentive, I think, for Elon Musk to produce, semis, that Anheuser-Busch and other major, fleet buyers of these trucks. So it'd be interesting to see if that happened. You agree on that score?
Yeah, no, absolutely. So I did take a second to try and look that up. So it looks like heavy duty vehicles are about 5% of the fleet stock or vehicle fleet stock in the U.S., but they make up about 1/4% of all transportation emissions, right? So they are highly emitting. And yeah, so right now there is no clean vehicle or EV credit for commercial fleet purchases. So the infrastructure or the Inflation Reduction Act introduces a commercial clean vehicle credit, right? And if it has no internal combustion engine, if it's 100% electric vehicle, you can receive a 30% investment tax credit, the max value of $40,000. So that's really meaningful for decarbonizing those fleets. And fleet operators also think differently than retail consumers. When a fleet operator purchases a vehicle, they're not simply looking at the the sticker price at the dealer. They're thinking about total cost of operation, and that's where electric vehicles outperform, right? Because prices of electricity, it's less volatile than diesel prices, and so this is going to be a big push for not only heavy duty vehicles but also like the sort of last mile Amazon type trucks, right? That are all over cities now because we're buying everything online and we get things delivered directly to our house. There's already been some traction there for clean vehicles. This really will accelerate that.
What is Manchin angling for, with his promised permitting reform, right? We're going to get something by September 30th, and explain why.
Yeah, we'll get something or we'll get a government shutdown. So we'll see. I guess that's still something. But yeah, so there's a one-pager out from the Manchin administration, and it's hard not to give this the priority it should. To make Manchin a yes vote on reconciliation, which became the Inflation Reduction Act of 2022, there was this quid pro quo, right, where Senator Schumer, who's the majority leader, and Speaker Pelosi and the House agreed to bring to the floor a legislation around infrastructure permitting reform. And this is a long-term ask from Senator Manchin, and honestly, most Republicans too as well. And so in Manchin's mindset, this is natural gas, right? West Virginia sits on top of Marcellus. It sits on top of this huge hydrocarbon asset that he wants to get to market, either as natural gas or as methane. He just wants to get pipelines. There's a derivative benefit for all infrastructure in this. All infrastructure, including upstream oil and gas, solar, electricity, and critical minerals and mining, right? They have to go through that touch in some way federal lands or affect federal waters, have to go through the National Environmental Protection Act, or NEPA. So clearest example here is that under Department of Interior, Bureau of Land Management, or BLM, implements a NEPA analysis, generally resulting in an environmental impact statement for anything that needs to be done in federal lands out west. So what is Senator Manchin asking for? He wants to get pipelines done. So he wants to accelerate the NEPA EIS process, and he wants to lower the litigation timeframes. Any project going through NEPA would benefit from that timeline, right? So the ask is for the environmental impact statement to take 2 years or less. Currently, the average time is north of 4 years, right? So that slashes that in half. And also it reduces the timeline around litigation. Basically, if litigants, generally on the environmental side, are successful in saying a permit shouldn't be issued, the issuing agency is on a really, really tight time frame to turn around an alternative order. What happens now is it takes FERC, which is the Federal Energy Regulatory Commission, 4 years to come up with a final EIS. It gets litigated for another 3 years, and then FERC sits on it for another 2 years before they reissue an order. So all in, your developer, you're waiting 6 years. It's extremely expensive, right? The economy has changed in 6 years. September is important. The United States government, I don't think we've been on a traditional budget really since back in the Obama administration. We operate on these short-term continuing resolutions to fund the government. The existing CR times out September 30th. So there will be a must-pass piece of legislation to fund the government that needs to get done by September 30th. The deal between Manchin, Schumer, and Pelosi is to tack on this infrastructure permitting reform, again, adding those sort of statutory timelines to get the NEPA EIS done, to tack that on to the funding bill, and then basically dare both parties to say, okay, you're going to vote against this and shut down the government. It's going to be interesting. We've already seen some really bearish comments from the Democrats, specifically on the progressive left, saying that we're not really interested in that. The House Progressive Caucus has in the past proposed legislation that actually extends the timelines for NEPA, so going in the opposite direction. And so Manchin's going to need Republican votes, and it's unclear if Republicans are going to be interested in giving Democrats more wins.
I've been very impressed with Manchin's political skill in this whole process. Fingers crossed, by September 30th, he's going to get some permitting reform. Thank you so much, John. Really appreciate the conversation, and you're, a huge repository of information. So to be continued.